All right, let's get right into it. We're going to break down a true masterclass from Warren Buffett's 2009 shareholder letter. Now, you have to remember the context here. This was written in the immediate aftermath of the 2008 financial crisis. The world felt like it was falling apart. And in the middle of all that chaos, Buffett lays out this timeless blueprint for durable investing. It's absolutely essential stuff.
And it all really starts with this one almost absurd question. I mean, look at that number. How in the world do you generate a 434,057% return? It sounds like a typo, right? But it's real, and the answer isn't some secret complex formula. It's about mastering a few fundamental principles that anyone can understand.
And this table really tells the story. Look at the consistency. Over 45 years, Berkshire more than doubled the S&P's annual gain. That kind of outperformance is staggering. The real how behind it isn't one big trick. It's a set of solutions to the biggest problems that every single one of us as professional investors has to grapple with every single day.
So the first problem is measurement. We are absolutely drowning in data and short-term noise. So how do you actually know if you're winning? And maybe even more important, how do you avoid deluding yourself about your own performance? Well, Buffett's solution is to have a rational, unbending standard. He's very open about it. He says the ideal metric, per share intrinsic value, is what truly matters, but you can't calculate it with any precision. So what does he do? He picks a practical proxy, per share book value, and he measures it against the S&P 500. Now, he's the first to admit it's crude, it's not perfect, but it is consistent, and using it prevents a very, very human temptation.
And there it is. This is all about discipline. For anyone managing capital, this is just crucial. You have to establish your metric for success before you start playing the game. Don't let yourself off the hook by changing the benchmark just because you had a bad quarter. Pick a rational yardstick and you stick with it, period.
Okay, so let's build on that. Once you know how to measure success, how do you avoid all the unforced errors? You know, the ones that derail even the smartest people in the room. This is the behavioral problem. And this is just a brilliant way to think about it. It's the mental model of inversion. Instead of trying to be brilliant all the time, Buffett and Munger just focus on consistently not being stupid. Think about that for a second. It's a huge shift. It suggests that greatness is often just the result of avoiding major blunders over a very long time. And this philosophy translates into a really simple, actionable checklist. Number 1, stay inside your circle of competence. If you can't evaluate it, avoid it. 2, a fortress balance sheet is non-negotiable. Don't ever depend on others for funding. 3, let your great managers run. Don't bury them in corporate bureaucracy. And 4, and this is a big one, your job is to talk to your partners, not to try and please Wall Street analysts. It's a clear guide for sidestepping the biggest landmines out there.
So now, let's get into the engine room. It's one thing to avoid mistakes, right? But it's another thing entirely to find a business model that is actively, powerfully working for you. For Berkshire, that economic engine has a special name: float.
And this is the absolute magic of their property and casualty insurance business. It's a collect now, pay later model. Insurers get all the premiums up front, but they only pay out the claims much later. That giant pool of money they hold in the meantime, that's the float. And the best part is, Berkshire gets to invest it for its own benefit.
You know, when Berkshire first got into the insurance game back in 1967, this engine was just getting warmed up. The float was a respectable $16 million. Not bad at all.
But just look at this. By 2009, through incredible discipline and scale, that engine had become a $62 billion juggernaut. And here's the kicker. Because they ran their insurance operations at an underwriting profit, this capital was actually better than free. They were effectively being paid to hold and invest billions of dollars. It's just an incredible business model.
Okay, but having access to all that capital, that creates its own very high-class problem. How do you deploy it wisely? Specifically, how do you avoid falling into what Buffett calls the acquirer's value trap, that all too common tendency for big M&A deals to just destroy shareholder value?
Buffett makes the math here painfully, brutally clear. If your own stock is trading below its true worth, using it as currency for an acquisition is basically financial suicide. In this example, you think you're paying $100 for the deal, but you're not. You're giving up shares worth $125 of real intrinsic value to get $100 back. You are actively cheating your own shareholders.
So what this really boils down to is just being ruthlessly honest about the true value of what you're giving, not just what you're getting. It's such a simple concept, but it is shocking how frequently it's ignored in boardrooms all over the world.
And this just gets to the heart of the problem. You have to be aware of the inherent biases at play. The advisors, the bankers who are pushing a deal, their incentives are often tied to the deal simply getting done, whether it makes any economic sense or not. You always have to view their analysis through that lens.
So let's bring this all together. How does all of this, the rational yardstick, the behavioral discipline, that powerful business model, and the M&A savvy, how does it all combine into a master principle? Well, it's about capitalizing on chaos, which is exactly what the world was facing in 2009.
The first piece of this is just realizing that the truly game-changing moments are rare. They don't happen every day, so you can't force them. Most of the time, your job is just to play good defense and wait patiently. But that means you have to have the capital and, just as importantly, the mindset ready to act decisively when they finally do show up.
And here's the second and most critical part of the puzzle. You have to understand where those rare opportunities actually come from. And almost without exception, they are disguised as terrifying market crises. When fear is absolutely rampant, when everyone is predicting the end of the world, that is when the bargains of a lifetime emerge. Fear becomes your single greatest asset.
And this, right here, is the punchline to the entire letter. When those rare moments of intense fear create once-in-a-generation opportunities, the correct response is not caution. It is maximum aggression. You have to go big, you have to deploy capital on a massive scale. In those moments, timidity is the enemy.
So, at the end of the day, this 2009 letter is so much more than a history lesson. It's a complete roadmap. But it's also a challenge. See, the principles, they're simple to understand, but they're incredibly difficult to actually execute in the real world, with real money on the line. The blueprint is right there for anyone to read. The real question is, who has the temperament and the discipline to actually build with it?